morning again from beautiful Monaco, and thank you for joining me again for another edition of Markets, Trends and Profits. As I mentioned in one of my previous videos, as many as 75% of all active traders actually lose money, as disclosed by various retail brokers. Ultimately, the key problem facing all traders, hedgers and investors is uncertainty, the unavoidable hard fact that we can't predict what might happen tomorrow, let alone 5 or 10 years from now. I also put forward two rather categorical statements, namely that trend following is probably the most reliable solution to the problem of uncertainty, and that market trends are the most powerful drivers of investment performance. These may come across as fairly strong statements, but as I mentioned, the evidence supporting them is very compelling, and this is what we're going to dive into today. So in today's video, I will explain why I believe that trend following is the best solution to the problem of uncertainty, and everything that I will cover in this video, and then quite a bit more, is condensed in my recent book, Alex Grainer's Trend Following Bible, which is available from Amazon, and I will post the link below this video. So again, uncertainty means that we can't reliably predict what might happen in the future. In investment trading, we can only make our decisions in the present, while the results of those decisions will depend on things that happen in the future. Our success as investors will ultimately depend on the quality of decisions that we take and execute over time. Investors have typically used and still use two conventional approaches in dealing with uncertainty. They use quantitative methods, or they use forecasting based on the analysis of economic fundamentals, or they use some combination of both. However, each of these two approaches has very significant shortcomings, as we are about to explore. Quantitative methods of market analysis seek to model security markets in order to identify predictive attributes in the data, and in that way gain an edge over the markets in investment trading. But in conducting quantitative research and building their models, quantitative analysts, or quants as they are called in the industry, they face two categories of challenges: conceptual issues and errors related to software coding. Conceptual problems stem from misunderstanding of the data and the relationships between the observed patterns. What typically happens is that a correlation between the observed patterns are mistaken for causation. For example, suppose that we identified that an event B follows some observed pattern A 75% of the time. This does not mean that A causes B, or that there's a 75% probability that B will happen the next time we encounter the pattern A. I'll give you a simple illustration of this. So let us suppose that we toss a coin 1,000 times and we mark the results: H for heads, T for tails. We will get a string of 1,000 characters looking something like this. Suppose further that in this string of characters we identified the pattern TTTHH 100 times, and we find that this pattern is followed by the letter T in 75 out of those 100 observations. In that case, it would be correct to say that in our sample, a T follows TTTHH 75% of the time. But it would be an error to say that there is a 75% probability of tossing a T after every TTTHH. This is because the result of any coin toss is determined by two equally probable outcomes. We either get heads or we get tails. The probability of either result is always 50-50, regardless of the patterns and correlations we might find in our data. With coin tosses, the probability math is easy to understand, but our ability to interpret market and economics data is easily overwhelmed by the complexity of the systems that produce that data. So, if quantitative analysts misinterpret market data, they are liable to formulate mistaken hypotheses and build flawed models. And then, supposing even that quants formulate a correct hypothesis, they still face another important challenge, namely, quantitative models are almost always based on software code. But writing software is a very error-prone business. Professional software programmers make as many as 100 to 150 errors per each 1,000 lines of code. We know this from the results of a large multi-year study of 13,000 programs conducted by Wes Humphrey of Carnegie Mellon University's Software Engineering Institute. Furthermore, coding errors can be very, very difficult to detect. If you follow financial media from time to time, you will come across stories about poor and sometimes outright disastrous results of quantitative trading. However, these stories are usually reported like unfortunate exceptions, isolated cases that only happen to some particularly unlucky or incompetent individuals. However, there is some empirical evidence that indicates just how difficult it is to achieve success with quantitative methods. In 2006, world's most popular trading platform provider, MetaQuotes, began to organize automated trading competitions. They offered a $100,000 prize for the winning algorithm. Over the next 6 years, these competitions attracted 2,726 participants. So these were all smart individuals or teams who were sophisticated enough to use market data and write trading algorithms. But they were also highly motivated to win the $100,000 prize. So out of those 2,726 who competed, only 567, or 21% of them, finished their competitions profitably. 79% of them actually lost money. So as you can see, the ability to use data, formulate quantitative trading strategies, and write code isn't as easy as many people assume. And this includes most of the financial industry professionals. The other conventional approach in dealing with uncertainty is the so-called econometric analysis and forecasting. Among professional investors, a large majority rely on market forecasts for their investment decisions. For that reason, vast resources are dedicated to analyzing markets and to trying to predict future developments. But this approach is also unreliable, as we'll illustrate with a few examples. The market for the United States Treasury debt is the single largest market in the world, and the interest rate on US Treasury notes represents the most important price in the global capital markets. In January 2019, the Wall Street Journal asked a group of experts to predict the interest rates on US 10-year notes for mid-year and the end year of 2019. The forecasts all range between 2.5 and 4.3%. In reality, the interest rate dropped below 1.5% and never came even close to the forecast of any of these market experts who reported to the Wall Street Journal. Our next example concerns the price of oil. Oil market is the most important and most closely studied commodity market in the world. Every year, United States Energy Information Administration, or the EIA, publishes an exhaustive report titled International Energy Outlook, which provides long-term forecasts produced by the EIA itself, as well as a number of world's leading research institutions. After many years of wide misses, the EIA changed the way it projected the near-term and longer-term oil price changes as a very broad range between the low and high future oil prices. The chart you're about to see shows the EIA's 2014 forecast. The dark blue line shows the actual price of Brent crude oil, and it's overlaid with the gray lines that represents the EIA's low, high forecast and reference forecast. These projections were based on the best information in the industry, produced by the most highly reputed institution in the world. And as you can see, the whole thing was badly wrong almost from the day it was published, and it's been almost completely wrong for over 7 years now. And this was in spite of the fact that they have painted this picture with a very broad brush, which presently spans more than $80 per barrel. Our last example concerns stock prices, another large market analyzed by an army of smart analysts. Twice a year since 1946, the United States Federal Reserve Bank of Philadelphia publishes the Livingston Survey, which summarizes various economic forecasts by 31 prominent economists from the government, industry, and the leading financial and academic institutions. In this chart, you can see the S&P 500 index with the Livingston Survey forecast for June 2007 and June 2008. Recall, in 2008 we had the great financial crisis. The dashed gray vertical lines coincide with the survey publication dates, and red and blue dots represent the economist's 6-month, 12-month, and 18-month forecasts. Again, as you can see, the experts were very widely off from what actually happened in the markets. We could go through many examples just like these, but the reason I singled out these three is because they concern large-scale price events in some of the world's most important and most closely studied markets. Also, the forecasts we reviewed were published by the world's most highly respected experts and research institutions. So the question that jumps out from all of this is, why is it that forecasts so regularly fail? What is it about the markets and the economies that even our top experts cannot make reliable predictions? The difficulties arise from a number of problems, but to sum it up in a nutshell, there are three major problems. To begin with, the information which analysts rely on to make their forecasts are usually incomplete, untimely, and biased. Often they are also plain wrong, in which case forecasting amounts to garbage in and garbage out. Another problem is that the sheer complexity of markets makes it very, very difficult to truly understand how all the moving parts are working together. But the issue that is least well understood, but at the same time it heavily influences the analysts and their forecasts, is the very real problem of groupthink among the experts. Analysts often work within a framework of some consensus view, whether this is explicitly stated or implicit. Diverging from that consensus always involves personal and professional risk. We see this all the time, whether we're talking about health, climate, social, cultural or economic issues. But for our purposes here, we will just focus on the concrete problem of groupthink in market price forecasting. We already looked at the EIA and their forecasts. In 2003, when the oil started its extraordinary ascent to new historical highs, the EIA's 2-year forecast, that is their forecast for 2005, were all clustered around the low $20 per barrel. At the same time, in the markets, the oil price more than doubled. The problem is that price forecasts have an impact on the reputation of the organizations that publish them. So even if in 2003 some smart analysts correctly predicted that oil price would more than double by 2005, their institutions would probably not publish such a forecast. From the organization's point of view, it is always safer to be wrong along with everybody else than to stray too far from the industry consensus, which is basically a nice word for groupthink. Challenging the groupthink always involves the risk of reputational damage, ridicule, and potentially even loss of business. Well, this groupthink or consensus basically represents the prevalent narrative that explains the conditions and changes in the organized life of our societies and the way we should understand and interpret those changes. With regards to the economy and markets, these narratives are being shaped non-stop by the media and particularly by the expert class that the media prop up. This in turn creates, or at least greatly exaggerates, the illusion of expertise. And this is the idea that experts understand market events accurately and that they can always explain the way the world events influence markets. Let me show you an example. These three headlines appeared on my Bloomberg page one day, all one below the other at the same time. As you read them, they say, yen rebounds, yen declines, yen advances, all bundled up with the definitive explanations for why those changes happened. The illusion is that the cause and effect relationships in the markets are all explainable and instantly understood with clarity, but this is not usually the case. Nevertheless, the media's obsession with offering explanations for every change in the market also creates the impression that it is these news events that actually move markets. In reality, while it is true that news events have some influence on market prices, this influence is usually quite limited and tends to have only a short-term impact. Let me explain this with another chart. Here we see the daily chart of the US 30-year Treasury bond, and I overlaid it with a few headlines that appeared along the way and that had presumably moved the market at the time. This is a daily chart, but for the moment the time scale and the price of the 30-year bonds are not in themselves so important. So here we have the headline that US inflation index rose to a 58-month high. This bit of news should actually have moved market prices lower, but that's not exactly what happened. Then we learned that the government revenues declined the most since the last recession, which would be the 2008-2009 recession. Then job reports showed economic growth and the price jumped on that day, as should be expected. Then we had some news about Brexit negotiations stalling the umpteenth time, but the market was evidently not too impressed with that. So all these news might have had some impact on the market price fluctuations, but the large-scale price events, the really significant changes in the markets, where investors tend to make the largest gains, these changes tend to unfold over long periods of time and invariably unfold as trends. Here we have the 20-year chart of the US Treasury bond, and all those news events and headlines that we just saw all happened at the very end of the chart in the highlighted region. In fact, if you picked any day on this 20-year chart, the media would have reported about some important world event for that day that would be then explained as the market-moving news. But when we zoom out from these narratives and look at the markets over longer stretches of time, we see that markets often manifest trends which can span many months or even years. And this brings us to the next part of our discussion, which is the simple contention that markets move in trends. Already 2,000 years ago, in his timeless book, The Art of War, Chinese General Sun Tzu identified trends as one of the great avenues of opportunity. For now, we'll just take a few examples of market trends, and to my mind, one of the most interesting ones is the price of gold in the 1970s. Prior to 1971, the gold price was fixed at $35 per ounce for over 30 years. At that time, the US economy wasn't doing so great, and because of the perceived market imbalances, it was expected that the price of gold would rise. But it was actually unthinkable that the ounce of gold would rise beyond $100 or more. But what happened over the next 10 years was that gold price increased 24 times and peaked in 1980 at $850 per ounce, which was the development that virtually nobody had predicted. Then here we have the long-term chart of the Nasdaq 100 index. During this interval, we see some major bear markets and significant corrections, but during the bulk of those 50 years, Nasdaq has been in a large uptrend that's increased the index value over 100 times. And in this chart, we see the prices of New York taxi medallions. This is a 25-year chart, and as you can see, over those 25 years, prices unmistakably traced a trend. First a long trend up, then a reversal, and then a significant sharp downtrend. What this chart tells us is that we can find trends in all kinds of markets, including collectible items, arts, wines, and just about everything else that people exchange. We could go through thousands of charts like this. Silver, crude oil, coffee, soybeans, Bitcoin, Amazon, Tesla. Literally, we'll find trends in almost any chart. And these large-scale price events, which are not driven by news but by the aggregate psychology of all market participants, they represent the greatest driver of investment performance, sustainably and over long stretches of time. So, to sum up, our core problem is uncertainty. And as I elaborated in this video, the way investors conventionally cope with uncertainty are rife with risks. Quantitative methods are subject to conceptual and software coding issues, while forecasting is at best a 50-50 proposition. The idea that anyone can make reliable predictions about the future is unrealistic, no matter how much effort and resources we put into that endeavor, because the information we depend on is untimely, partial, and distorted. Some of it will prove outright false. The only kind of market information that is accurate, unambiguous, and almost instantly available are the prices of assets themselves. Security prices and the data series describing their fluctuations over time therefore provide an important way to understand markets. By understanding markets, I don't mean the kind of understanding that forms opinions and narratives, but the kind that enables us to make decisions with a certain degree of confidence and positive expectancy for speculative profit. And as we have seen, asset price histories strongly support the idea that markets move in trends, the fact that's been observed since at least 2,000 years. In my next video, I will share with you some fascinating and very compelling evidence supporting this idea. But before I go, let me show you a concrete recent example showing the contrast in performance between market experts relying on forecasts and news narratives and the strategies of systematic trend following. Here we have the daily chart of Brent crude oil price since January 2009. At that time, the news agency Reuters polled 1,000 energy market professionals and asked them to predict the price of oil through 2023. Most of these experts predicted that price of oil would remain in the $65 to $70 per barrel range, which was only slightly higher from the price of oil at that time. 1 year later, in January 2020, the CEO of one of the world's largest trading companies, and I won't mention his name just in case that could get me in trouble, he similarly predicted that oil price would trade between $60 and $70 per barrel. None of these experts predicted that in 2020 oil price would collapse by over 70%. The large oil trading company CEO, whose CEO I just mentioned, allegedly lost $1.6 billion in the crash. The budget airline Ryanair lost $325 million on their hedging position. Hin Leong, one of Asia's largest oil traders, lost $3.8 billion, and the ABN AMRO Bank lost $1.4 billion. As a believer in trend following, I used the I system, the model I had developed some 20 years ago, and for that reason I did not have to know the future. I did not need to read analyst research reports or follow any media narratives. I simply tracked a set of systematic trend following strategies. And here is how iSystem strategies performed during last year's price crash. As the oil price began to slide during January and February 2020, iSystem strategies gradually shifted from the long to the short size, capturing large profits from the move. From February through mid-April 2020, they generated a profit of over $42 per barrel. With that, I'll wrap up this report, and in my next video we'll discuss the performance potential of systematic trend following and why I believe that trends are far and away the most powerful drivers of investment performance. Believe me, you won't be disappointed. It's a very fascinating discussion. But until then, please give this video a thumbs up, and if you appreciate the content I have shared thus far, subscribe to my channel. I look forward to connecting again, and in the meantime, keep well, keep free, and thank you for joining me once more today.